Imagine sitting in front of your trading screen, watching the price move slowly, almost teasing you. You see a setup forming, a move that looks perfect, and you feel confident this is your moment. You enter the trade, but soon after the market snaps against you, hits your stop loss, and then, almost mockingly, reverses back in the direction you expected. That frustration, that sudden feeling of being outsmarted, that's not just bad luck. That's the psychology of a liquidity trap, and it's what we're going to explore in this first part. So, what exactly is liquidity? Simply put, liquidity is how easily you can buy or sell something in the market without causing big price changes. But let's make it even simpler. Imagine a swimming pool. If you are in the shallow end, even small movements in the water make big splashes. That's like a market with low liquidity. Small trades can cause big swings. Now imagine the deep end where tons of water can absorb waves without much disturbance. That's high liquidity. This is what big players like institutions and smart money need because they trade huge amounts. Without liquidity, they can't enter or exit trades without causing the market to jump around wildly. Here's the key idea. Retail traders like you and me unknowingly provide this liquidity. Every trade we make, every stop loss we place, every hesitation and panic decision, all of it becomes available for bigger players to take advantage of. Your stop loss isn't just a number on the chart. It's a tiny target that institutions use to get their orders filled. When your trade gets stopped out, someone else's larger trade has successfully been executed. This is why liquidity is so important. It's the bridge between small trader losses and big player gains. Now let's talk about why smart money actually hunts this liquidity. Institutions don't just randomly move the market. They wait for the perfect moment when enough retail traders have placed their orders, especially stop losses, near obvious levels. Once that pool of orders is large enough, they push the price to trigger those stops, creating a surge in activity that allows them to enter or exit huge positions without losing money. This is why you often see the market dip below support or spike above resistance before moving in the expected direction. That's the liquidity hunt in action. By the end of this part, you should understand that the market is not just numbers and charts. It's a reflection of human emotions: fear, greed, hope, and impatience. Liquidity is the invisible thread connecting all these emotions, and understanding it is the first step in seeing the blueprint behind every trap. Over the next parts, we'll break down exactly how stop losses create liquidity, what slippage is, how to identify high potential zones from candles, and how institutions orchestrate these moves, all in a way that makes it simple to understand and relate to real-life trading experiences. This is your foundation, the starting point for seeing the market not as random chaos, but as a carefully structured playground where emotions drive liquidity, and liquidity drives every move you see on the chart. In this second part, we're going to dive deeper into one of the most critical concepts for understanding the psychological blueprint of a liquidity trap: stop losses and how they create liquidity. If you've ever wondered why the market seems to hunt your stops, this is the part that will finally make it click. Let's start with the basics. A stop loss is a safety tool. It's a price level you set to automatically exit a trade to protect yourself from bigger losses. Simple, right? But in reality, stop losses do more than just protect you. They act as tiny targets for bigger players. Imagine a large institution wanting to buy millions of dollars worth of a stock or index. They can't just push the market up and down wildly because that would move the price too much and make their own entry expensive. Instead, they wait for areas where small traders have clustered their stop losses because these stops provide ready-made liquidity. When these stops are triggered, your order executes automatically, giving the institution exactly what they need: a smooth way to get in or out without causing huge swings. Think about it in everyday terms. Imagine a supermarket sale. If everyone rushes for the last bottle of a product at the same time, the store can use that rush to move inventory efficiently. In trading, your stop loss is like that rush. It's a concentrated pool of orders that institutions can use to execute their massive trades. And the sneaky part? You don't even realize you're part of it. You think the market just moved against you by chance, but in reality, your stop is being hunted because institutions planned for exactly this behavior. Now let's connect this to emotions. Stop losses are directly tied to fear. Fear of losing more than you're comfortable with. Every retail trader who sets a tight stop is essentially signaling, here's where I will give up. Smart money watches these signals. They push the price to these levels, creating a cascade effect. Stops are triggered, liquidity is generated, and the market reverses in the direction they wanted. It's like a perfectly choreographed dance, but the steps are all driven by human psychology. Your psychology. But there's more. This stop-loss hunting is closely tied to slippage. Slippage happens when your order doesn't execute exactly at your stop level, but a little worse, because the market moves too fast due to the sudden surge of triggered orders. In other words, when all the retail stop losses get activated at once, the market temporarily becomes illiquid in that tiny zone, and your order is filled at a less favorable price. It can feel frustrating, but it's just another part of how liquidity and psychology interact. By now, you should start seeing the bigger picture. The market is not randomly moving to hit your stops. Every small trader, every fear-driven exit, every cluster of stop losses contributes to a pool of liquidity that smart money relies on. Understanding this is crucial because it shifts your perspective. Losses are not personal failures or bad luck. They're part of a system where human emotion creates opportunities for larger players. In the next parts, we'll continue this journey by exploring why liquidity is so essential for trades, how the absence of liquidity affects the market, and the simple ways you can start spotting high-potential zones on your charts before the big players do. This understanding will begin to change how you see the market. From a chaotic, unpredictable place to a logical structure built around human behavior and emotion. In this third part, we're going to explore why liquidity is so important for every trade and how it connects directly to the moves you see on your charts. Without liquidity, even the most obvious setup can fail, and understanding this will change the way you approach the market entirely. Think of liquidity as the fuel that moves the market. When there's plenty of liquidity, large players can enter and exit positions smoothly, and price movements are orderly. But when liquidity is low, even small trades can create big, unpredictable swings. Imagine trying to move a large truck through a narrow alley. Every tiny obstacle makes it difficult, slows it down, or forces a sudden stop. That's exactly what happens in a low liquidity market. The price jumps erratically, stops get hit unexpectedly, and your trade can go against you, not because your analysis was wrong, but because the market didn't have enough participants to absorb the move properly. Now, let's connect this to the concept of trading psychology. Most retail traders focus on patterns, indicators, or news, thinking these are the key drivers. But the truth is, the real driver is liquidity, or more precisely, where liquidity is concentrated and how it moves. Smart money and institutions know exactly where the clusters of stop losses and pending orders are. They wait for the right moment when enough liquidity exists to make their moves without causing chaos for themselves. Your emotions, your fear of missing out, and your impatience create these clusters, and they become the playground for large players. An important point here is that without liquidity, trading becomes unpredictable. You might see a strong support or resistance level, but if there aren't enough participants willing to buy or sell at that level, the price can easily spike past it. That's why simple technical analysis alone is not enough. Understanding liquidity and how it flows is what separates a reactive trader from a proactive one. When you begin to see charts through the lens of liquidity, you start noticing patterns that others miss. Small pauses where the market gathers orders, sudden quick moves to trigger stops, and areas where large players are likely to step in. In real life, this is exactly what institutions exploit. They don't fight the market randomly. They wait for the points where retail traders have created sufficient liquidity, then execute their trades efficiently. Your awareness of these zones allows you to avoid becoming part of the trap and instead identify high potential areas where the market is likely to react. By the end of this part, you should have a clear understanding that liquidity is not just an abstract term, it's the lifeblood of every trade. Recognizing how it works, why it's needed, and how it interacts with human behavior sets the stage for understanding slippage, smart money tactics, and how to identify potential zones on the chart, which we'll cover in the next parts. In this fourth part, we're going to break down how trading without sufficient liquidity can hurt you and why understanding this concept is crucial before placing any trade. Many traders look at a chart, see a support or resistance level, and assume that price will naturally respect it. But here's the reality. Without enough liquidity, even the strongest levels can fail, and your trade can get trapped. Imagine trying to sail a large ship in a narrow river. Even if you know the route perfectly, a small blockage or ripple can push your ship off course. That's exactly what low liquidity does in the market. When there aren't enough buy or sell orders to balance the trade, prices become erratic. Stops get hit prematurely, candles spike in unpredictable directions, and what seemed like a solid trade setup turns into a frustrating loss. This is why trading in low liquidity zones is risky. It's not about skill or knowledge, it's about the market not having enough volume to support smooth movement. Now let's link this back to psychology. Traders often feel frustrated or confused when a setup fails in a low liquidity environment. They blame themselves or think the market is random, but in reality, it's a predictable consequence of insufficient liquidity. Every market move requires participation from multiple traders. Without it, even smart money can't move efficiently, and retail traders get caught in the gaps. Understanding this removes the emotional fog from trading because you start seeing patterns in these failures rather than taking them personally. This also ties directly into slippage. When liquidity is low, your orders might not get filled at the price you expect. A buy order can be executed slightly higher, a sell slightly lower, and your stop loss might trigger earlier than planned. This is not a flaw in your broker or strategy. It's simply the natural effect of low liquidity interacting with market psychology. Recognizing where liquidity is thin and avoiding trades in these zones is a skill that separates disciplined traders from reactive ones. By the end of this part, you should understand that trading without liquidity is like trying to run on quicksand. The market can move in any direction unpredictably, and your emotional reactions, fear, frustration, impatience, only make the situation worse. Recognizing liquidity zones and waiting for proper participation is the first step toward making smarter, more controlled trades. In the next parts, we'll explore how smart money and institutions orchestrate these moves and how you can read the charts to identify where they are likely to act. In this fifth part, we're going to dive into one of the most fascinating aspects of the market, how smart money and institutions actually move the market, and why understanding their actions can completely change the way you trade. Most retail traders think that price moves randomly or that news alone drives the market. The truth is far more strategic. Large players control the flow, and every move is carefully orchestrated to take advantage of liquidity created by other traders. Let's start with the basic idea. Smart money doesn't just buy or sell at will. They wait. They observe. They know where clusters of stop losses, pending orders, and emotional traders are located. Their goal is simple: enter or exit large positions without moving the market against themselves too much. Imagine trying to push a massive truck through a crowded street. If you push too quickly, it gets stuck or crashes. Instead, institutions wait until there's enough room, enough liquidity to make their moves smoothly. And here's the key. Retail traders, by their actions, often unknowingly create the exact conditions institutions need. Think about this in a relatable way. Suppose you're at a busy concert trying to get close to the stage. Everyone moves together, creating gaps and spaces naturally. A few people in the crowd don't even realize they're making room for others to move. This is exactly how smart money operates. They wait for the moments when retail traders' fear and greed create gaps in the market. Clusters of stop losses, overextended positions, or areas where many traders have hesitated, and then they execute their trades in these high liquidity zones. Now let's connect this to psychology. Smart money is essentially exploiting predictable human behavior. Fear, greed, hope, and impatience all show up on the chart as identifiable patterns. For example, when price approaches a popular support level, many retail traders place stop losses just below it. Institutions notice this cluster. They nudge the price down slightly to trigger these stops, generating a surge of orders that allows them to enter long positions efficiently. From the outside, it might look like a sudden dump or fake breakout, but in reality, it's a controlled maneuver based on collective psychology. Candles and chart patterns are your clues here. Each candle represents the battle between buyers and sellers. Large wicks, sudden spikes, and rejections often indicate where liquidity exists or where it's being hunted. By observing these signals, you can start seeing where institutions might be active. You don't need complicated indicators to understand this. Just watch the way price reacts to key zones and notice the repeated patterns. Over time, these small clues form a map of potential liquidity zones that smart money uses to move the market. Another important concept is order flow. While it sounds technical, it's simple. Order flow is essentially the sequence of trades that shows who is entering and exiting the market. When many small traders get trapped, their orders are filled in a predictable way, which allows institutions to execute their strategies efficiently. This is why sometimes it feels like the market knew exactly where to move. It did, because the liquidity was already there, shaped by human psychology. By understanding this, you start to see the market as a structured system rather than random chaos. Losses, fake breakouts, and sudden reversals are not coincidences. They are the natural result of a psychological game where retail traders provide liquidity and smart money exploits it. Recognizing these patterns allows you to step back patiently and make decisions without falling into emotional traps. In the next parts, we'll continue building this blueprint by breaking down how to identify these high-potential liquidity zones using candles, technical terms made simple, and the step-by-step process of reading the market in a way that even a beginner can relate to and understand. This understanding is the foundation for seeing through the traps and making smarter, more controlled trades. In this sixth part, we're going to explore how to identify high-potential liquidity zones using candles and why this skill is crucial for avoiding traps and making smarter trades. Many traders think candles are just simple price bars showing open, high, low, and close. While that's true on a basic level, each candle tells a story about human behavior, psychology, and the invisible flow of liquidity in the market. Once you learn to read these stories, you can start spotting where smart money is likely to act. Let's start with the basics. Each candle represents a battle between buyers and sellers during a specific time period. A long body indicates strong conviction in one direction, while a small body with long wicks shows indecision or a tug of war. But the most important part is the wicks, the shadows above or below the body. These wicks often indicate areas where liquidity exists. For example, a long lower wick at a key support level shows that sellers tried to push the price down, but buyers stepped in aggressively. Those failed attempts to push price further often signal a cluster of stop losses or pending orders just below that level. Smart money watches these wicks carefully because they highlight zones where liquidity can be captured. Now let's connect this to psychology. Every wick, spike, or candle rejection is the result of human emotion, fear, greed, or hesitation. When you see multiple candles rejecting the same price zone, it tells you that retail traders are consistently placing stops or orders there. Institutions use this information to plan their entries or exits. In other words, candles are not just random shapes, they are footprints of human behavior, showing exactly where liquidity has accumulated. Another important concept is order absorption. When smart money pushes the price to hunt liquidity, they need to absorb all the orders in that zone without creating excessive slippage. Candles give clues about this absorption. For example, a sudden spike followed by a long wick and a close back near the opening price indicates that orders were absorbed efficiently and the market is ready for the next move. Observing these patterns repeatedly helps you recognize potential high probability zones where institutions are likely to act next. Let's make this relatable. Imagine a crowded room where people are trying to get through a door. Some people hesitate, some rush, and some step back. The path they create is predictable. It shows where movement is easiest. In the market, candles show the same thing. Hesitation, panic, and momentum create a visual map of liquidity zones. By learning to read these maps, you start understanding where the market is likely to react and where traps are most probable. By the end of this part, you should see that candles are much more than simple charts. They are windows into trader psychology and liquidity placement. Recognizing these zones allows you to anticipate potential reversals, avoid stop-loss hunting traps, and align your trades with the moves of smart money. In the next parts, we'll go further into technical terms simplified for easy understanding and how to connect them with real-life trading experiences so that spotting liquidity zones becomes second nature. In this 7th part, we're going to simplify some technical terms that traders often find confusing and show how they directly relate to liquidity and smart money moves. The goal here is to make everything easy to understand, even if you're a beginner, because knowing these terms will help you read the market more clearly and avoid falling into traps. Let's start with the term support and resistance. At its core, support is simply a price level where buyers tend to step in, and resistance is where sellers are likely to act. But here's the catch. These levels are only meaningful if there's enough liquidity. A support level without sufficient buyers is like an empty net. It won't catch anything. Smart money knows this, so they look for zones where many stop losses or pending orders are clustered, often just below support or just above resistance. That's where they can create liquidity and execute big trades efficiently. Next is the concept of swing highs and swing lows. These are just the peaks and valleys on your chart, but they're important because they often act as psychological points where traders place stop losses or enter trades. A swing low is a likely spot for stop-loss hunting because many traders assume that if the price breaks it, the trend has changed. Institutions exploit this predictable behavior, triggering stops to create the liquidity they need. Swing highs work the same way, but in reverse, providing zones for selling or entering short positions. Then we have order blocks. This term sounds complicated, but it's really simple. An order block is a zone where large players have previously entered the market with significant size. These blocks act as magnets for liquidity because when the price returns to these areas, it often encounters the same clusters of orders, stop losses, or pending entries. Candles in these zones often show long wicks or sudden spikes, signs that smart money is active and absorbing orders. Another term is liquidity pools. Think of them as clusters of stop losses, pending buy or sell orders, and emotional trader activity. These pools are what institutions hunt. When the market moves to grab these pools, it triggers a flurry of activity, creating opportunities for big players to execute trades efficiently. Recognizing where these pools exist is crucial because they tell you where the market might move next and where traps are likely to occur. Finally, let's touch on slippage again, in simple terms. Slippage happens when your order is filled at a worse price than expected, usually because the liquidity in that zone is getting absorbed too quickly. It's the natural consequence of large players hunting liquidity, and it's why retail traders often feel frustrated when they think they entered a perfect trade, but still get stopped out at a worse level. By the end of this part, you should understand that these technical terms are not random jargon. They are practical tools to identify where liquidity exists, how smart money is likely to act, and how you can position yourself to avoid emotional traps. In the next parts, we'll combine all of these concepts into a step-by-step process for spotting high-potential liquidity zones in real time, making your trades smarter and more controlled. In this 8th part, we're going to dive deeper into how slippage works and why it's directly tied to liquidity and smart money tactics. Many traders experience slippage and think it's a broker error or just bad luck, but in reality, it's a natural outcome of how liquidity flows in the market and how institutions execute their trades. Understanding this will help you anticipate it and use it to your advantage rather than being frustrated by it. Slippage happens when there aren't enough orders at the exact price you want to enter or exit. Imagine you're trying to buy a popular product online during a flash sale. You click buy at $50, but because thousands of people are ordering at the same time, the final price you pay is $52. The system filled your order with the next available stock at a slightly higher price. That's exactly what happens in trading. When the market hunts stop losses or hits a liquidity pool, a sudden surge of orders floods the zone. Your order is then executed at the next available price, which can be slightly better or worse than your intended level. Now let's connect this to psychology. Slippage often triggers an emotional reaction, frustration, panic, or impatience. Traders might feel like the market is cheating them, but in reality, slippage is the market reflecting the imbalance between available liquidity and the demand at a specific price. Smart money counts on this effect. They know that retail orders will get filled with slippage, and they design their entries to take advantage of these predictable behaviors. Another key point is that slippage is more pronounced in low liquidity zones. When fewer buyers or sellers are present, a single large order can move the price significantly. This is why entering trades in thin zones without understanding liquidity is risky. The market can spike or drop rapidly, stop losses can be triggered unexpectedly, and retail traders are often caught off guard. Observing where slippage commonly occurs can actually give you clues about where liquidity clusters exist, essentially showing you where smart money is active. Let's make this relatable. Think about a busy highway with a traffic jam. If one big truck tries to squeeze through, it causes a ripple that slows or pushes surrounding cars unpredictably. The same happens in trading. Large institutional trades move through the market and your smaller orders get slipped along in the process. Understanding this mechanism changes your perspective. Slippage isn't a problem to complain about. It's information. It tells you where liquidity is being absorbed, where stops are clustered, and where smart money is likely operating. By the end of this part, you should understand that slippage is a natural, predictable part of trading when large players interact with retail liquidity. Recognizing it and connecting it to the broader concept of liquidity and smart money tactics allows you to stay calm, plan your entries better, and avoid emotional reactions. In the next parts, we'll focus on practical ways to combine all these concepts: liquidity, stop losses, candles, and psychology to identify high probability zones on your chart and trade more strategically. In this ninth part, we're going to put together everything we've discussed so far and focus on how to spot high potential liquidity zones in real time using simple observations from candles, stops, and market behavior. This is where all the concepts, liquidity, stop losses, slippage, and smart money psychology start to connect, giving you a clear framework to make smarter trades. First, let's talk about the visual cues on the chart. Candles tell a story. Long wicks, sudden spikes, and areas where multiple candles hesitate or reverse often indicate where liquidity exists. These are zones where retail traders have clustered stops or pending orders. For example, if price approaches a previous swing low and repeatedly rejects it with long lower wicks, it's likely that stop-loss orders are concentrated just below that level. This creates a liquidity pool that smart money can target. Recognizing these zones gives you insight into where the market might move next. Next, observe repeated price behavior. When a level gets tested multiple times, it's not random. It's the market probing liquidity. Smart money often nudges the price to trigger stops in these areas before taking it in their desired direction. So, a seemingly small dip below support or spike above resistance is not chaos. It's a planned hunt for liquidity. Understanding this allows you to anticipate reversals and avoid emotional traps. Another key factor is the relationship between stop-loss clusters and recent price structure. Swing highs and swing lows, order blocks, and zones of consolidation are all areas where retail traders place stops. By noting where these stops are likely concentrated, you can identify high-potential zones, areas where the market might pause, reverse, or accelerate once liquidity is absorbed. It's like reading footprints in the sand. The market leaves subtle clues about where larger players are active. Now let's connect this to psychology. Every hesitation, spike, or candle rejection represents human emotion: fear, greed, or uncertainty. Retail traders often act predictably in these zones, providing liquidity for smart money. By observing these patterns without reacting emotionally, you can position yourself on the safer side of the move, play, either by waiting for confirmation or by trading in alignment with the flow of liquidity rather than against it. Finally, remember that not all zones are equal. Some areas have more liquidity potential than others, and part of becoming a disciplined trader is learning to weigh the strength of these zones. Larger clusters of stops, previous swing levels, and visible order absorption indicate higher probability setups. Over time, by combining candle observation, stop loss understanding, and knowledge of smart money behavior, you'll start to see the market as a structured system rather than random chaos. By the end of this part, you should be able to look at your chart and identify at least a few potential liquidity zones, understand why they exist, and anticipate how smart money might interact with them. In the next parts, we'll explore step-by-step strategies for aligning your trades with these zones and avoiding emotional mistakes that cause most retail traders to lose. In this 10th part, we're going to explore how to align your trades with liquidity zones and use this understanding to avoid emotional mistakes that trap most retail traders. Up until now, we've discussed what liquidity is, how stop loss is created, how slippage works, and how smart money hunts it. Now it's time to take all that knowledge and turn it into practical trading behavior that keeps you on the right side of the market. The first step is patience. One of the biggest mistakes retail traders make is jumping into a trade as soon as the price approaches a key zone. This is usually driven by fear of missing out or impatience. But when you understand liquidity, you know that these zones are often tested multiple times before a move occurs. Waiting allows you to see how the market interacts with the zone, whether stops are being absorbed, orders are being filled, or the zone is holding strong. Patience gives you a higher probability of entering after the initial stop hunt, rather than becoming part of it. Next, focus on confirmation signals from candles. Look for reactions that show the market is respecting the liquidity zone. Long wicks, rejections, or consolidation near the zone indicate absorption of orders. This tells you that smart money has likely acted, and the market may now be ready for a directional move. Entering a trade before seeing these confirmations increases the risk of being stopped out prematurely. Observing candle behavior helps you filter out traps and align your trades with the real flow of the market. Another key principle is position sizing and risk management. Even when you identify a high potential liquidity zone, remember that the market can be unpredictable in the short term. Smart money may still create minor fakeouts to trigger residual stops. Keeping your trade size appropriate ensures that even if you experience slippage or a brief stop hunt, you're not overexposed. This discipline separates consistent traders from those who react emotionally to every spike or wick. Now let's bring in the psychological side. Understanding liquidity zones gives you a mental advantage. You stop blaming yourself for every stop loss hit and start seeing them as part of the system. This shift reduces stress and impulsive trading. By observing the market objectively and respecting the structure of liquidity, you can avoid revenge trades, panic exits, and overtrading, all common mistakes caused by emotional reactions rather than strategic planning. Finally, combine multi-timeframe observation with your liquidity analysis. Higher timeframes often show major liquidity zones where large clusters of stops are concentrated, while lower timeframes reveal intraday liquidity flows and absorption points. Using both perspectives allows you to align trades with larger market structure while timing entries more precisely, increasing your probability of success. By the end of this part, you should have a clear understanding that aligning your trades with liquidity zones is not about luck. It's about patience, observation, risk management, and psychology. In the next parts, we'll start breaking down real-life examples and scenarios to make these concepts even more relatable and actionable, showing exactly how to spot, interpret, and trade liquidity zones in the market. In this 11th part, we're going to make all of this more practical by looking at real-life examples and scenarios to see how liquidity traps actually play out in the market. Theory is important, but seeing it applied in real situations is what helps you internalize these concepts and trade smarter. Imagine a popular stock or index approaching a well-known support level. Retail traders see it as a safe buy zone and place their stop losses just below the support. The market dips slightly, hitting these stops, causing a chain reaction where more stops are triggered, and suddenly there's a quick downward spike. If you were trading without understanding liquidity, you might panic, thinking the setup has failed. But if you know this is a liquidity hunt, you recognize the pattern. The market just collected enough orders to allow smart money to enter a large long position efficiently. Moments later, the price reverses strongly in the original direction, often surpassing the support level and moving higher. This is a classic liquidity trap. Retail stops provide the fuel for institutional moves. Another scenario is during a breakout attempt. Price pushes above a resistance level. Retail traders jump in expecting a strong trend, but the breakout fails quickly, reversing back below the level. Many traders get stopped out or trapped in losing positions. Why? Because smart money identified that retail orders were clustered above resistance, creating a liquidity pool. By pushing the market to trigger these orders, institutions gained the liquidity they needed to enter larger positions on the reversal. Observing these patterns repeatedly allows you to anticipate where fake-outs might happen, so you're not reacting emotionally to each spike. Let's also consider intraday examples. During market open or major news events, liquidity can be thin in certain zones. Retail traders act impulsively, chasing moves or placing stops too close. Institutions exploit these moments, causing rapid spikes or dips that seem unpredictable. But with practice, you start to see the signals. Long wicks, rejection candles, or clusters of trades in certain areas indicate where liquidity is being hunted. By waiting for confirmation and observing the market's reaction, you can align your trades with the flow rather than getting caught in it. Psychologically, these examples teach a crucial lesson. The market is not out to get you personally. Every stop-loss hit, every reversal, every slippage event is a result of predictable human behavior that institutions plan around. Once you understand this, you stop taking losses emotionally and start viewing them as part of a larger system. This shift in mindset is key to avoiding impulsive trades and learning to trade patiently and strategically. By the end of this part, you should be able to look at a chart and identify potential liquidity hunts in real time, relate them to stop-loss clusters and candle behavior, and start seeing the market as a structured, predictable system rather than random chaos. In the next parts, we'll dive deeper into step-by-step strategies for trading these zones, combining observation, psychology, and technical understanding for practical execution. In this 12th part, we're going to focus on step-by-step strategies for trading liquidity zones, combining all the concepts we've discussed so far: candles, stop-loss clusters, smart money behavior, slippage, and psychology, into a practical approach that's easy to follow and actionable. Step 1 is identify the high potential zone. Look for areas where multiple candles show rejection or hesitation, swing highs and lows align with past support or resistance, and stop-loss clusters are likely to exist. These are the zones where liquidity has accumulated and where smart money is most likely to act. Think of it as spotting the gathering point before a major move. Step 2 is observe market behavior within the zone. Don't jump in immediately. Watch for signs of order absorption. Long wicks that push against the zone but then close back near the opening, small consolidations indicating stops are being filled, or sudden spikes that reverse quickly. These behaviors show that the market is clearing liquidity and preparing for a potential directional move. Patience here is critical. Entering too early often results in being caught in a stop hunt. Step 3 is confirm with candle patterns. Look for rejection candles, engulfing patterns, or other simple formations that indicate the zone is holding and that smart money has completed its liquidity collection. This confirmation reduces risk and increases the probability that your trade aligns with the market's real flow. Remember, candles are not just shapes. They are footprints of human behavior and liquidity interaction. Step 4 is manage risk carefully. Even in high probability zones, the market can behave unpredictably for short periods. Place your stop loss beyond the zone where liquidity is unlikely to be hunted further, and size your positions appropriately. This protects you from slippage and unexpected spikes, while keeping your emotional state stable. Discipline in this step separates consistent traders from reactive ones. Step 5 is align with higher timeframes. Check where major liquidity clusters exist on higher timeframes while using lower timeframes to time your entry. This dual perspective ensures you're trading in the direction of institutional flow while optimizing your entry for minimal risk and maximum reward. Finally, always observe and learn from every trade. Whether it succeeds or fails, analyze how the market interacted with the liquidity zone, how stop-loss clusters influenced the move, and how your emotions played a role. Over time, you'll develop an intuitive sense for spotting liquidity zones, understanding stop-loss hunting, and reading smart money behavior. By the end of this part, you should have a clear, actionable framework for approaching trades in liquidity zones. You now know where to look, how to confirm, how to enter safely, and how to manage risk. In the next parts, we'll explore common mistakes traders make in these zones and how to avoid them, ensuring you don't fall into emotional or psychological traps while trading. In this 13th part, we're going to discuss common mistakes traders make in liquidity zones and how to avoid them. Even with a solid understanding of liquidity, stop losses, and smart money tactics, emotional and behavioral errors can cost traders heavily. Recognizing these mistakes is just as important as spotting the zones themselves. The first common mistake is rushing into trades without confirmation. Many traders see a liquidity zone forming and immediately enter, driven by fear of missing out. They ignore the signs of order absorption, wick rejections, or consolidation, and end up being part of the stop hunt themselves. Patience is key. Always wait for clear confirmation from candle behavior before committing to a trade. The second mistake is setting stop losses too close. Tight stops may seem like a smart risk management tool, but in reality, they often place you directly in the path of liquidity hunting smart money. Retail stops just below support or above resistance become easy targets. By setting stops slightly beyond obvious liquidity zones, you reduce the chance of being prematurely stopped out while staying within a safe risk limit. Another mistake is ignoring slippage. Traders often assume they'll get filled exactly at their intended price. But in high activity zones, orders can be filled at slightly worse levels due to rapid absorption. Ignoring this can lead to frustration and poor decision-making. Accept slippage as part of the market and plan for it in your risk management. A fourth mistake is overtrading in multiple zones. Just because liquidity exists in several areas doesn't mean you need to trade all of them. Jumping from zone to zone leads to emotional fatigue and higher chances of losses. Focus on the highest probability zones where the market shows strong signs of stop-loss absorption and order flow confirmation. Lastly, traders often take losses personally. A stop-loss hit is not a personal failure. It's part of the system. Retail traders provide liquidity, and losses are the cost of being part of the market structure. Viewing losses objectively prevents emotional reactions like revenge trading, which can quickly wipe out your account. By the end of this part, you should recognize that discipline, patience, proper stop placement, and emotional control are just as important as spotting liquidity zones. Avoiding these common mistakes ensures that your trades align with the flow of smart money rather than working against it. In the next parts, we'll dive deeper into how to read multi-timeframe liquidity zones and connect higher and lower timeframes for precise trade execution. In this 14th part, we're going to explore how to read multi-timeframe liquidity zones and why combining higher and lower timeframes gives you a significant edge in understanding market structure and smart money behavior. Most traders make the mistake of focusing on a single timeframe, thinking that the price action they see there is all that matters. But the truth is, liquidity and institutional moves operate across multiple levels, and seeing them together allows you to trade with far more confidence and accuracy. Let's start with the higher timeframe perspective. Charts like the 4-hour daily or weekly timeframe show where major liquidity zones exist, areas where a large number of stops, pending orders, and historical price reactions have occurred. These zones are where institutions and smart money place their large positions because they need substantial liquidity to execute trades without moving the market too much. For example, a daily support level that has held multiple times in the past becomes a magnet for retail stop-loss clusters just below it. Understanding these major zones gives you a map of the market, showing where the most significant moves are likely to originate. Now, let's move to the lower timeframe perspective. Timeframes like 5-minute, 15-minute, or hourly charts provide the fine details, how liquidity is being absorbed, where stops are triggered, and how candles react within the major zones. On these charts, you can see intraday wicks, spikes, and reversals that indicate smart money is actively hunting liquidity. For instance, a strong spike below a key support followed by rapid absorption and consolidation is a clear sign that stops are being cleared and a high probability move may follow. Lower timeframes allow you to time your entry precisely while still respecting the major zones identified on higher timeframes. The real power comes when you combine both perspectives. Higher timeframes tell you where the market is likely to react, and lower timeframes tell you when to enter or exit. Think of it like scouting a battlefield. The higher timeframe shows the strategic positions of troops, while the lower timeframe shows the skirmishes and openings you can exploit safely. Entering a trade without this dual perspective is like charging blindly. You might get lucky occasionally, but more often than not, you'll be caught in stop hunts or false breakouts. Let's also connect this to psychology and behavior. Retail traders often react emotionally on lower timeframes, chasing moves or placing stops too close. Smart money takes advantage of this by using the liquidity created in both high and low timeframe zones. Observing how price interacts with these zones across timeframes allows you to anticipate potential manipulations and align yourself with the natural flow of the market rather than reacting impulsively. Over time, you'll start recognizing recurring patterns, like how stop-loss clusters on lower timeframes often coincide with major higher timeframe zones, creating the perfect setup for institutional moves. Another crucial point is risk management across timeframes. When you identify a major liquidity zone on a higher time frame, you can use lower time frame observation to refine your stop placement and entry. This minimizes the chance of being caught in unnecessary slippage or a fake out while keeping your risk-reward ratio favorable. You're essentially stacking probabilities in your favor by combining strategic, higher time frame, and tactical, lower time frame perspectives. By the end of this part, you should understand that multi-timeframe analysis is not just a technique, it's a mindset. It trains you to think like smart money, seeing both the big picture and the fine details simultaneously. You'll be able to identify high potential liquidity zones, understand where institutional orders are likely influencing price, and time your trades to maximize the probability of success. In the next parts, we'll explore real examples of multi-timeframe analysis in action, showing how combining higher and lower timeframes can reveal liquidity hunts and stop-loss zones that are invisible on a single chart. This will help you start applying these concepts in your trading with confidence. In this 15th part, we're going to dive into real examples of multi-timeframe analysis in action, showing exactly how combining higher and lower timeframes reveals liquidity hunts, stop-loss zones, and institutional activity that many traders completely miss. This part is crucial because seeing theory applied in realistic scenarios makes all the previous concepts, liquidity, stop-loss clusters, smart money, and psychology, much easier to internalize and use in your trades. Let's start with a higher time frame example. Imagine you're looking at a daily chart of a major index. You notice a strong support zone that has held multiple times in the past. The price bounced off this level repeatedly, indicating that buyers consistently stepped in. Retail traders see this as a safe buy zone and often place their stops just below it. Institutions notice this clustering of stops because it represents a pool of liquidity they can exploit. On the daily chart, you see the zone clearly, but you can't see how the stops are being triggered intraday. That's where the lower time frame comes in. Switching to a 15-minute or 5-minute chart, you can see price approaching that same support zone. Notice the small dips below the support, forming long lower wicks that quickly recover. These spikes are the stop-loss hunts. The market briefly dips to trigger retail stops, absorb orders, and create liquidity for the institutions to enter their positions efficiently. Retail traders often panic here, thinking the setup has failed, but observing the candle behavior shows that the zone is holding, and smart money is now positioned for the next move. This is a perfect demonstration of how higher and lower timeframes work together to reveal the hidden structure of the market. Now let's take a breakout scenario. On a higher time frame, you identify a key resistance level that has been tested several times. Retail traders place buy stops just above the level, expecting a breakout. On the lower time frame, you see a sudden spike above resistance, followed by a quick reversal and consolidation back below the level. This is another classic liquidity hunt. Smart money pushed the price to grab retail stops, absorb the orders, and then allowed the market to reverse. Recognizing this pattern in real time helps you avoid chasing breakouts and positions you to trade with the flow rather than against it. Another real-life observation involves order absorption zones. On the lower time frame, you might notice several small candles with long wicks and close near the open, forming a consolidation zone. Meanwhile, the higher time frame shows that this area aligns with a previous swing low or high. This combination indicates that the market is absorbing stop-loss orders and preparing for a significant move. Waiting for the next confirmation candle in alignment with the higher time frame zone increases your probability of entering a successful trade. Psychologically, these examples teach an essential lesson. The market reacts to predictable human behavior, not randomness. Every spike, wick, or rejection is a reflection of retail emotions, fear, greed, and impatience interacting with liquidity zones. By observing both higher and lower timeframes, you start to anticipate these reactions, reduce emotional trading, and align yourself with institutional flow. By the end of this part, you should be able to take a real chart, identify potential high-probability liquidity zones using multi-timeframe analysis, recognize where stop-loss hunts occur, and understand how smart money structures its moves. In the next parts, we'll explore practical techniques for combining these observations with simple trading setups, showing you how to execute trades with clear entry, stop-loss, and take-profit strategies based on liquidity zones. In this 16th part, we're going to focus on practical techniques for combining multi-timeframe observations with simple trading setups, giving you actionable strategies to enter, manage, and exit trades based on liquidity zones. Up until now, we've talked about theory, psychology, and examples. Now it's time to translate all that into real executable steps that even beginners can understand and apply. Step 1 is marking your liquidity zones on both higher and lower timeframes. On the higher time frame, identify major swing highs, swing lows, support, and resistance levels where stop-loss clusters are likely to exist. On the lower time frame, observe candle behavior, wicks, and minor consolidations to pinpoint intraday liquidity pools. Highlighting these zones visually on your chart allows you to see where smart money is likely to act and where stop-loss hunts may occur. Step 2 is waiting for confirmation before entering a trade. Patience is critical here. Look for candles that show absorption of orders. For example, a spike below a support, followed by quick recovery and close near the open, or a rejection candle forming at a resistance level. These patterns indicate that liquidity has been collected and the market may now move in a predictable direction. Entering immediately without confirmation often leads to being trapped in stop hunts. Step 3 is placing your stop loss strategically. Instead of putting it just below support or above resistance where retail clusters exist, place it slightly beyond the zone. This ensures that minor stop hunts or slippage won't prematurely trigger your stop while still keeping your risk defined. Pair this with proper position sizing so that even if the trade goes slightly against you, your account is protected. Step 4 is timing your entry using lower timeframe structure. Look for alignment with the higher timeframe zones, small consolidations, rejection wicks, or clear directional candles that indicate smart money is active. By combining the strategic view from the higher time frame with tactical entry timing from the lower time frame, you dramatically increase the probability of success. This step bridges the gap between knowing where liquidity exists and actually entering trades safely. Step 5 is setting realistic take-profit levels. The next high-probability liquidity zone or swing level on the higher time frame often serves as a natural target. Avoid unrealistic expectations. Let the market move to the next structural level while you stay disciplined. Always monitor candle reactions near these zones. Long wicks or repeated rejections indicate absorption, signaling potential areas to take partial profits or exit fully. Finally, step 6 is review and adapt. After each trade, analyze how price interacted with your marked liquidity zones, how candle structure supported or contradicted your entry, and whether smart money behavior aligned with your expectations. This feedback loop is essential for refining your understanding of liquidity, improving timing, and developing an intuitive feel for the market over time. By the end of this part, you should have a complete practical framework. Mark liquidity zones, wait for confirmation, time entries using multi-timeframe observation, place stops strategically, manage exits at logical levels, and learn from every trade. In the next parts, we'll explore real-world mistakes in execution and how to avoid them, ensuring that these setups lead to consistent, disciplined trading rather than impulsive decisions. In this 17th part, we're going to focus on real-world mistakes traders make during execution and how to avoid them. Even with a perfect understanding of liquidity zones, multi-timeframe analysis, and candle behavior, execution errors can turn a high-probability setup into a losing trade. Identifying and correcting these mistakes is crucial for consistency and long-term success. The first common mistake is entering trades too early. Traders often see a liquidity zone forming and immediately place orders, fearing they might miss the move. This is usually driven by impatience and FOMO, fear of missing out. The problem is that early entries often coincide with stop-loss hunting or temporary wicks, resulting in unnecessary losses. The solution is to wait for clear confirmation, a rejection candle, absorption of orders, or consolidation within the zone before entering. Patience separates reactive traders from disciplined ones. The second mistake is chasing price after it has moved. Many traders see a spike or breakout and immediately jump in, thinking the move will continue. In liquidity zones, these spikes are often smart money hunting stops or creating liquidity. Entering during the spike increases the risk of slippage and getting trapped. Instead, observe whether the price returns to a logical level within the zone or forms a confirmation candle before committing. A third mistake is ignoring proper stop-loss placement. Placing stops too close to the zone makes you vulnerable to minor fluctuations and smart money maneuvers. Conversely, placing them too far increases risk unnecessarily. The key is to set your stop just beyond the liquidity zone, accounting for potential spikes while keeping risk within your acceptable range. Pair this with appropriate position sizing for optimal risk management. Fourth, traders often overtrade in multiple zones or attempt too many setups simultaneously. Just because liquidity exists in several areas doesn't mean all setups are worth trading. This leads to emotional fatigue, poor judgment, and mistakes in execution. Focus on high probability zones where the higher and lower timeframe observations align, and avoid the temptation to trade every minor opportunity. Another frequent mistake is letting emotions dictate exits. Traders may exit too early out of fear or hold too long out of greed. Liquidity zones give you a logical framework for exits. Target the next high probability zone, observe absorption patterns, and adjust if the market shows unexpected behavior. Avoid impulsive reactions. The market moves according to structure and psychology, not personal emotion. Finally, traders sometimes fail to review their trades. Even small mistakes in execution can be corrected if you analyze what went right or wrong. Ask yourself, did I wait for confirmation? Was my stop-loss placement correct? Did I account for slippage? Did I follow the framework of multi-timeframe analysis? This reflective practice trains you to execute consistently and reduces repeated errors. By the end of this part, you should recognize that execution discipline is just as important as strategy. Even a perfect plan can fail without patience, proper entry timing, correct stop placement, and emotional control. In the next parts, we'll discuss advanced cues and subtle signs in the market that reveal where smart money is moving, helping you refine your entries and exits even further. In this 18th part, we're going to explore advanced cues and subtle signs that reveal where smart money is moving, helping you refine entries, exits, and overall trade timing. While earlier parts focused on clear liquidity zones and candle confirmations, the market often leaves subtle hints that can give you an edge if you know what to look for. These signs are not obvious to most retail traders, but can drastically improve your probability of success. The first cue is minor wicks and micro reversals within a larger liquidity zone. On lower time frames, you may notice small candles with tiny bodies, but long wicks forming repeatedly at a certain level. These indicate that smart money is testing the zone, absorbing orders without pushing the price too far. Retail traders often ignore these micro reversals, but observing them helps you anticipate a larger move once absorption is complete. Think of it as watching footsteps before a big crowd enters a concert. Subtle movement signals preparation. The second cue is order flow imbalance. Even if you don't have access to full order book data, candle behavior can reveal where buying or selling pressure is concentrated. For example, a sudden spike in volume followed by quick rejection shows that one side's order absorbed by stronger opposing orders. Recognizing these imbalances allows you to see where liquidity has been taken and where the next directional move is likely to occur. Another subtle sign is failed breakout attempts. Price may push above resistance or below support, only to quickly reverse back into the zone. These fakeouts often occur in areas dense with stop-loss clusters. Institutions use these moves to grab liquidity, and observing how the price reacts, how quickly it returns, and the size of the candles helps you distinguish between genuine breakouts and traps. This allows you to avoid chasing false moves and enter with a higher probability. Next, watch for consolidation after a spike or drop. When the market absorbs liquidity, it often pauses or moves sideways briefly. This consolidation is like a calm before the next directional move. Retail traders may interpret this as indecision and enter early, but careful observation shows that the pause usually precedes a stronger, more predictable movement. Entering after this consolidation with confirmation from candle structure increases your chances of trading alongside smart money. Finally, pay attention to repetition of patterns across timeframes. If a high probability zone on a higher time frame coincides with subtle micro reversals or absorption patterns on a lower time frame, it's a strong indicator that smart money is active. The market often repeats these cues in similar conditions, and recognizing these repetitions allows you to anticipate moves before they happen rather than reacting afterward. By the end of this part, you should understand that the market communicates with subtle signals: micro wicks, volume spikes, fakeouts, and consolidation patterns, all revealing where liquidity is being collected and how smart money is positioning itself. Observing these cues in real time sharpens your ability to enter and exit trades with precision, reducing emotional errors and aligning your strategy with institutional behavior. In the next parts, we'll move into how to combine these advanced cues with risk-reward calculations and trade management to make your trading not just smart, but consistently profitable. In this 19th part, we're going to focus on combining advanced cues with risk-reward calculations and trade management, showing you how to turn observations of liquidity, smart money activity, and candle patterns into disciplined, consistently profitable trades. Understanding where liquidity exists is powerful, but pairing it with proper risk-reward management is what separates successful traders from those who struggle. Step 1 is defining your risk-reward ratio before entering any trade. Even in high-probability liquidity zones, trades can temporarily move against you due to minor stop-loss hunts or market noise. Decide in advance how much you're willing to risk relative to the potential reward. A common standard is at least a 1-to-2 or 1-3 risk-reward ratio, meaning your potential profit should be at least twice or 3 times your risk. This ensures that even if some trades fail, your winners more than compensate. Step 2 is aligning entries with advanced cues. Observe subtle wicks, micro reversals, and consolidation patterns within your identified liquidity zones. Enter only when these cues indicate that smart money has absorbed enough liquidity and is likely ready to move the market in the expected direction. Combining this observation with predefined risk-reward levels ensures that your entries are both strategic and disciplined. Step 3 is strategic stop-loss placement. Place your stops slightly beyond the liquidity zone, not just below support or above resistance where retail stops cluster. This protects your trade from minor spikes, slippage, or fakeouts while keeping your risk contained. Remember, stop losses are not just a safety net. They're part of your calculated risk-reward framework and help maintain emotional discipline. Step 4 is dynamic take-profit management. Use higher timeframe liquidity zones, swing highs-lows, and observed absorption patterns to set logical targets. You can take partial profits at the first realistic zone and let the rest run toward the next higher probability level. Observing candle behavior near these zones allows you to adapt in real time. If rejection candles appear, consider exiting or tightening stops to lock in gains. Step 5 is continuous trade monitoring and adjustment. Market conditions can change quickly and liquidity flows can shift. Watch how price interacts with your zone. If absorption is incomplete or the move loses momentum, you may adjust your stop or take partial profits. Combining advanced cues with risk-reward logic allows you to remain flexible yet disciplined, avoiding emotional exits or impulsive trades. Finally, review every trade. Analyze how the market behaved relative to your liquidity zones, whether your stop loss and take profit levels were well placed, and whether advanced cues aligned with the outcome. This reflective practice builds intuition, improves timing, and reinforces the discipline required to consistently trade alongside smart money. By the end of this part, you should understand that observing advanced cues without disciplined risk-reward management is incomplete, and risk-reward strategies without observing market cues are blind. Combining both allows you to enter, manage, and exit trades with confidence, maximizing potential profits while controlling risk. In the next part, we'll move into how to integrate all these concepts into a full trading routine, creating a structured step-by-step process for analyzing, entering, and managing trades daily in alignment with liquidity and smart money behavior. In this 20th and final part, we're going to bring everything together and show you how to integrate all the concepts of liquidity, stop-loss hunting, smart money psychology, multi-timeframe analysis, and advanced cues into a complete trading routine. By now, you understand what liquidity is, how stop loss is created, how slippage occurs, how to read candles, and how institutions manipulate the market. You also know how to combine higher and lower timeframes, spot subtle advanced cues, and manage trades using proper risk-reward strategies. The next step is creating a structured, repeatable process that ensures you trade with consistency rather than emotion. Start your routine by scanning higher timeframe charts for major liquidity zones and swing levels. Mark these zones clearly, then move to lower timeframes to observe intraday candle behavior, absorption patterns, and micro reversals. Wait for clear confirmation signals before entering any trade. Always calculate your risk-reward ratio in advance, place your stop loss beyond obvious stop loss clusters, and define your take profit targets using the next high probability zones. Throughout the day, monitor price interactions, note absorption and reversals, and adjust your positions if necessary, always staying disciplined and avoiding impulsive decisions. Remember, trading is not about guessing. It's about following a system, observing the market, and aligning with smart money behavior while controlling risk and emotions. Finally, thank you for staying with me through this full deep dive into the psychological blueprint of a liquidity trap. If you found this video helpful, make sure to subscribe to the channel, like this video, and comment your thoughts or any questions you have. I read all your comments and try to help whenever possible. Don't forget to check out all our other videos on the channel for more trading strategies, insights, and tips to improve your skills. For more personalized guidance or doubts, feel free to reach out to me on Instagram or leave your question in the comments, and I'll guide you through it. Following this routine and understanding these concepts will give you a serious edge in the market, and I truly appreciate you watching till the very end. Thanks for your time, your patience, and your dedication to learning how the market really works.